Okay, thank you so much.
Thanks.
Welcome, everybody. We are recording, so if you want to not be seen or heard, that's your prerogative. We will post the recording afterwards on the website. You'll all receive a link, so have no fear. If you think you might miss something, you'll be able to catch up. And welcome. So here we are talking about the magic of life insurance. Now, I think magic is a good word. I had the privilege of growing up in my father's life insurance agency. I'm second generation in this business. And actually, I have spent most of my life in the life insurance business. And when I say magic, I mean magic. When you deliver checks to grieving widows and grieving widowers and surviving business partners, it is very much like waving a magic wand because all their sorrows are certainly not wiped away, but you know what? A lot of worry is, and it's very magical. And I will tell you that some of the most emotional and rewarding times in my life I've experienced have been when I have delivered these kinds of checks. So, and I really want people to feel that magic. So that's why we're doing this. With us, we have two of my colleagues. We have Charlene, and Charlene is our marketing maven. And I know that people have texted with her, spoken with her. And one thing I will tell you that's not known is that she is an animal whisperer. She has dogs and cats, and she knows what these animals are going to do before they do. It's a hidden talent. We have Darren Hardison. Darren is our chief consultant. Darren has the unique blend of skills. He is both a life insurance underwriter. He actually served part of his career with a very famous life insurance company in their underwriting department. Plus, he's a financial planner and investment advisor, so he knows about life insurance from the big picture about how it fits into your portfolio. So I'm privileged to have Darren on board and be the first point of contact with our clients' sales and service. So we have a very good team, and there's many others that we bring into play as needed. So that's us. And the way we're going to run this is we're going to give you an overview of today's topic, which is the difference between term insurance and permanent insurance, so that you're confident making a decision between the two, or maybe for both, depending on what your needs are. The usual format is that when you want to quote, we pre-qualify you, which means that we look at all the underwriting issues up front, get a commitment from an underwriter to a rate so that you know the rate is reliable and that you can get approved at the rate quoted. That's the way to buy life insurance. That's the way it should be done. So here we go. I'll be the master of ceremonies. If you have questions that relate to the general topic, please put them in the chat. If you have questions that relate to you personally, let us know. You can just have a private message, and we'll be sure to follow up with a private counseling session. Okay. So without further ado, Darren, let me call upon you. Please
Very
give
good.
us a summary of what is the difference between term insurance and permanent insurance, and why would people buy one as opposed to the other?
Yeah, good question. First of all, thank you, Steve, and hello, everybody attending live today, and hopefully many more watching later via recording. To circle back, Steve's task is to keep me focused and on point. I can talk forever about everything. We're going to stay very focused today about the different types of life insurance and why one over the other, or a lot of times a combination of both. I always like to start with how we define insurance internally. I know a lot of our clients have an idea. They think they know what insurance is, or they have insurance. But in our minds, what we see as insurance is simply providing financial protection against a loss, right? And we're deferring that financial risk to an insurance company. Let them worry about it. We'll pay a small premium and let the insurance company bear the big potential financial risk. So I think that helps people kind of wrap their heads around what insurance is and why they may need it. I always like to give examples. We all typically are required to have auto insurance, to prevent the risk of having to pay out of pocket for a huge replacement of an auto or, a huge auto repair expense. We insure our homes for similar reasons. And then for the topic specific today, we insure our lives to protect our families, to protect our businesses, and other needs and other reasons. So for today, and I'll get focused here. Two general types of life insurance: term insurance, which is relatively self-explanatory. We're buying pure insurance. We want to protect ourselves, our families, our businesses for a specific period of time. Maybe you buy a personal term life insurance to carry during your working years. I don't want my family to lose my income stream from age 40 to 65. So it's going to protect my family. God forbid if something happens, I'm going to have this policy in place that's going to provide a lump sum of money to help my family financially. And then, maybe the thought is, well, gosh, once I'm retired, I won't have the same needs for insurance. I may have other needs, but that larger term life insurance policy has served its purpose. I always like to say this. So term insurance, where you're buying a policy that we hope you never use. You're buying something purely for protection. Steve, I don't know that we've ever had a client upset that they didn't use their term life insurance. So you're buying that protection. And when the term period is over, then we have another conversation, and then it's like, well, let's project forward. What are our needs for the next 10, 20, or throughout retirement? So term insurance. Is there any other aspects of term insurance you think I should comment on?
I think that with term insurance, your emphasis on time period is important here. For instance, if somebody has a 30-year mortgage, it makes sense to have 30-year term insurance. If somebody has a partnership agreement and their plan is to work for only 10 or 15 years and then retire, then it makes sense to have a 10 or a 15-year term insurance, because the need for insurance is for a defined amount of time. And then somebody like me and somebody like you is going to say, okay, well, you have other needs that may not be for a defined amount of time, such as children, or such as caring for elderly parents, such as on and on and on. So there might be an additional policy needed. So I think that's a point to be made, because if somebody has a feeling, if they're not quite sure for how long they would need coverage to protect their family or their business, term insurance might not be the way to go, because if they buy term insurance and they feel like, oh, now I still need it, the price is going to go up and there'll be some liability. So that's your good entree into permanent insurance. What do we do with people who don't quite know for how long they'll need the insurance, especially these days? They might refinance and they might be in debt to a bank for 40 years, or their kids might be 32, still living at home, this kind of stuff.
Right.
So how do we handle that situation?
I'll circle back quickly in regards to term insurance. This is kind of a Steve and I thing. When Steve and I were much younger men in our early days, you're still young, Steve. 20 years seemed like a really long time. So
Yeah.
I don't know if it's happenstance or coincidence. Most people, I say most people, the most common term duration is 20 years. We sold 20-year term insurance. Gosh, that seems like forever.
Yeah.
Well, fast forward, Steve and I have been around, let's say, more than 20 years. So, policies that we've sold 16, 17, 18, 19, 20 years ago, these people are like, why didn't you sell me a longer term policy?
Yeah.
So, and I always say this, I'm working with some people, clients of ours right now, and they're like, well, gosh, I don't know. I really think I only need 10 or 15. I'm like, I hear you. Humor me. The cost to get that additional 5 years, get a 20-year term, you're guaranteed they can't raise your price. You pay the premium, they're on the hook for 20 years. You get to 10, 12, 15 years and you determine you don't need the policy, we can terminate it. Or you can change the beneficiary or change the ownership. This circumstance is actually for a business owner. You need it for key person protection. That's fine. The power of having a policy in place is very important as you get older. The cost of insurance goes up. We usually say 7 to 12% per year just based on age. Even if you remain squeaky clean, perfectly healthy, we know things happen as we get older. We get heavier. Our blood pressure goes up a little bit. We start taking medication, a little case of diabetes, a little heart, a little of this. And Steve and I specialize in impaired risk. We can get you coverage. It'll just cost more. So you're a greater risk to the insurance company. So they're going to charge you a premium commensurate with what they see you as a financial risk to them. So my point being, for anybody who's watching and listening, term insurance, even though it has a finite window, is very powerful. Another thing I wanted to comment on, a lot of people, I don't know that we stress it enough on the front end, is the majority of term insurance policies have a provision that says they'll provide the parameters. Usually it's based on age or to the end of the term duration, is they allow you to convert that policy to a permanent policy. You're like, well, why would I do that? Why is that important? It's very powerful if someone's had a change in health, or maybe has become uninsurable, or even temporarily uninsurable. They're going through a cancer treatment, and they'll probably be fine, and everything will work out. But for insurance purposes, we hit a roadblock, and we're approaching end of term. I can't get new insurance. I don't want to have a gap. I still need some level of protection. Let's exercise this guaranteed conversion privilege. And that may be a topic, Steve, that we talk about on another session, but it's really neat. So if anybody watching has existing coverage, maybe that you've got from another advisor, that's something that we can review. It may be something we can help you understand.
All right, so that's like having your cake and eating it too, meaning that, let's suppose somebody bought 20-year term insurance and then they realize, oh, gee, my kids are almost out of the house, but now my parents are dependent on me. That happens a lot. And I find that my income is needed by dependents. They just happen to be older than me. That happens. Okay, so now they're in a situation where they do need coverage for a longer amount of time. So Darren, under those circumstances, they might be thinking term insurance, but since they don't know how long they're going to need it for, you're saying maybe term conversion is the way to go. So let me ask you, why wouldn't they consider buying permanent insurance at the original time of purchase, considering that they need to protect not only their kids, but maybe even their parents? Why wouldn't somebody just buy permanent insurance from day one?
Yeah. Let's segue to permanent insurance. So remember I said term insurance, we hope you're buying a financial product that you won't use. I mean, it's protection. Um, if we reach the end of the term and you're happy and healthy and wealthy and wise, everybody wins, then it's just, let's figure out the next thing. So term insurance, I'm purchasing it for peace of mind, to defer risk. Permanent insurance, you're buying something that with 100% certainty, it's going to pay a benefit. So you're in essence, again, I'm a financial advisor, you're putting a piece inside of your financial plan. Okay, so if you're buying a $100,000 permanent policy, you don't know when, at least you probably don't know when, your estate, your financial plan will receive a cash flow of $100,000 at some point. Okay, so to Steve's point, well, why wouldn't I do that initially? Honestly, it really comes down to cost. So think of it this way. Insurance companies are statistical actuarial creatures, right? They run the numbers and they price term insurance, again, based on the individual's health parameters, financial parameters, hazardous sports, hobbies, you know, what have you. And again, that stresses the importance of why we do pre-qualification, so we can get our hands on accurate rates up front to be sure we're going to the correct companies. Again, we're life insurance brokers, we're independent. We work with every company under the sun. We don't have an affinity to any group. It's whoever's best for our clients. But usually clients at younger ages who have families or have, you know, businesses, they need more insurance. They need a higher amount of protection. Where because of the certainty and because of the risk and the insurance company understanding that they're paying that benefit, the premium's higher. So it's kind of it's a risk reward. And a lot of times it comes down to a client's premium threshold. They say, well, gosh, I need this much coverage. Here's the amount of premium I can reasonably afford per year. So a lot of times we'll look at both term insurance and permanent. Maybe we do a large portion of term insurance and have a smaller portion of permanent that carries on once the term insurance drops off.
All right, so you're talking about like a layered approach where,
yeah, we call it a ladder, a layer. Yeah.
Right, laddered policies where different policies and different amounts are in place for different needs over different times. Okay. Right. So that brings up the fact that people often have multiple needs for life insurance, even just for personal use, to protect family, let's say, and cover personal debts. And then if they have a business interest, that even adds more needs for life insurance. Okay. One challenge or one objection really of people, I think, to permanent life insurance has been the cash component, because they say, like, I do okay in the market, or I have ways of creating wealth. I don't need life insurance to do that. Although these days, considering what's happening in the marketplace, and considering that interest rates have just got bumped up a little bit, the cash value component of life insurance might be more appealing. But having said that, if there's people that really insist, I just need pure protection, but I don't know for how long I'll need it. I like it on a permanent basis, but I don't need the cash inside the policy. For those people, tell us, Darren, what is our solution in terms of a permanent term type coverage? Pure protection on a permanent basis.
Yeah, so I always explain to people, insurance companies are very proactive and they're reactive to some degree. So one, insurance companies have more money than virtually everybody else in America. So they've got a lot of smart people designing, we say, new mousetraps. So just to go back a minute, So when people think of permanent insurance, and it actually was the first type of insurance, I wrote a paper on this a bazillion years ago, whole life insurance. Whole life insurance, I think, started in 17 something. George Washington probably sold it to somebody. So the premise of whole life insurance is, you pay a set premium, you have a set death benefit, and well, in the old days, companies were mutual companies, and there still are a few. So they would declare a dividend, in essence, an interest payment, and you would have a cash value account, like a savings account, and then the death benefit would grow in accordance with the cash. So your policy would ratchet up over time. You needed access to the money. You could take a policy loan. You could surrender the policy. Fast forward, to recent times, very expensive. Whole life is very expensive compared to other options. So fast forward even further, companies said, well, gosh, we understand that people need permanent insurance. They want to know that this policy is guaranteed as long as they think they need it. Age 100, if you have crazy genetics, we'll guarantee it to age 121, okay? Steve and I call it permanent term insurance. So you're buying a policy at a minimum premium, still commensurate with your age and your risk classification. There's minimal, if any, cash values, but they're guaranteeing the death benefit. So regardless of what happens in the economy, interest rates, consumer price index, stock market, they are on the hook to pay that death benefit as long as you pay that premium. Okay, so think of it like permanent term insurance. Now, they've even gotten more creative lately. There's a number of companies that say, okay, we'll make it even more interesting in that, and they'll usually pick certain years, say policy year 20, maybe year 25 and 30, we'll guarantee if you decide you don't need the policy, we'll refund a percentage of your premium. So it's kind of not to entice somebody to get out, but if someone says, okay, my circumstances have changed, are you kidding me? I've had coverage for 20 years, 25 years, and now I can walk away with 50% or 100% of what I've paid into it. So there's some really exciting things. At least we get excited about it. For somebody who needs the permanent coverage, but still wants to have what I call an exit strategy. What if I want to get out? I think I know what I want, but I'm not exactly sure. So that's kind of the new thing out there, is this guaranteed universal life with some kind of cash surrender feature.
I'm really glad you mentioned that. And that's like what I want to be our final point. This is why the purchase of life insurance needs to be considered in the context of your financial planning. It's not just a transaction. You don't just go online and buy a policy because it's cheap. Because in the long run, inevitably, find out you fell short, you have to buy another policy when you're 49 years old, another policy when you're 63 years old, and net, you spend too much money. So I'm very happy that you shared your planning perspective, Darren, and you showed how people's thinking about their finances and their future does have a real bearing on the policy they buy now. So good job for that. And also, as you mentioned, this is an underwriting driven purchase. Whether you are considering getting the lowest possible price or the highest maximum cash accumulation, whatever strategy you use, it's really a question of which company is going to give you the best underwriting, because that will keep the cost as low as possible and either have you spending less money out of your pocket or getting more bang for the buck in terms of cash accumulation. So thank you for that. As we wrap up, let me just ask if anybody has any general questions or comments they want to make. Okay, we're good. Thank you for attending. So we have our next seminar on July 13th. Stay tuned. If anybody needs assistance before then, We'll be reaching out to see what's on your mind. And let me say, on behalf of everybody, thank you so much and have a good rest of the day. So long now.
All right, guys.